Here is a question that almost no Canadian can confidently answer. You have $500 this month to put toward your financial future. You have a TFSA, an RRSP, and an FHSA all open and available. Which account gets the $500? Most Canadians default to one account without knowing why. They put it in the TFSA because they heard it was good, or the RRSP because their parents recommended it, or they split it evenly because that feels balanced. Almost none of them have run the actual math on which account produces the best outcome for their specific income, their specific goals, and their specific tax situation. That decision, which account gets your next dollar, is one of the most important financial choices you make every single year. And getting it wrong costs real money. Not theoretical money. Real money, in the form of taxes paid that did not have to be paid, government benefits not claimed that should have been, and compounding returns lost to the wrong vehicle. Here is what this video will give you by the end. A complete, plain language explanation of how each of the three accounts actually works, the single critical difference between them that most Canadians misunderstand, and an exact decision framework, built for 5 different types of Canadian, that tells you precisely which account gets your next dollar based on your income and your goals. No jargon, no complexity, just the answer. Before comparing them, let's make sure every viewer understands what each account actually is. In plain language. The TFSA, Tax-Free Savings Account. You contribute after-tax dollars, money you have already paid tax on. It grows completely tax-free inside the account. When you withdraw, you pay zero tax, no forms, no CRA involvement. The money is simply yours. 2026 annual contribution limit, $7,000. Cumulative room for those eligible since 2009, $109,000 as of 2026. Withdrawals restore your contribution room on January 1st of the following year, meaning you can withdraw and recontribute without permanently losing room. No age limit for contributions. No mandatory withdrawal age. No forced conversion. The TFSA is the most flexible registered account in Canada. It works for any goal: emergency fund, short-term savings, medium-term goals, retirement income. It does not affect OAS clawback, GIS eligibility, or government benefits of any kind. The RRSP, Registered Retirement Savings Plan. You contribute pre-tax dollars, or more precisely, you contribute after-tax dollars and receive a tax deduction that generates a refund. Every dollar contributed to an RRSP reduces your taxable income by exactly that dollar, generating a refund at your marginal rate. At $70,000 Ontario income, a $10,000 RRSP contribution generates approximately $2,965 back. At $100,000, approximately $4,341 back. 2026 annual contribution limit, the lesser of $32,490 or 18% of your 2025 earned income, plus any unused room from prior years. All growth is tax-deferred, not tax-free. When you withdraw in retirement, you pay tax at your then current marginal rate. The RRSP is most powerful when your marginal rate during contribution is higher than your marginal rate during withdrawal. Mandatory conversion to RRIF at age 71. Minimum annual withdrawals required from the RRIF, fully taxable as income. The FHSA, First Home Savings Account, launched in 2023. The newest and arguably most powerful account for eligible Canadians. Contributions up to $8,000 per year, $40,000 lifetime, are tax-deductible like an RRSP. Withdrawals for a qualifying first home purchase are completely tax-free like a TFSA. It combines the single best feature of each account. Unused contribution room carries forward 1 year, allowing a maximum annual contribution of $16,000 in the second year and beyond. To qualify, Canadian resident, at least 18 years old, have not owned a qualifying home in the current year or the previous 4 calendar years. If you never buy a home, transfer the balance to your RRSP or RRIF without affecting your RRSP room. Zero penalty for changing your mind. As of 2023, 739,000 Canadians had opened FHSAs with $2.79 billion in total value. 57.2% of contributors were aged 25 to 34. 61.4% earned over $60,000. Action step: log into CRA, My Account right now. Check your TFSA room. Check your RRSP deduction limit on your Notice of Assessment. If you are a first-time buyer and do not have an FHSA, open one this week. Contribution room begins accumulating from the year you open the account. Here is the complete comparison across the 5 dimensions that actually matter for deciding which account gets your next dollar. Dimension 1. Tax treatment on contribution. TFSA, no deduction. You contribute after-tax dollars. No immediate tax benefit. RRSP, tax deduction. Reduces taxable income by the full contribution amount. Generates a refund at your marginal rate. FHSA, tax deduction. Same as RRSP. Reduces taxable income. Generates a refund at your marginal rate. Winner for immediate tax reduction. RRSP and FHSA tied. Dimension 2. Tax treatment on growth. TFSA, tax-free. All growth, capital gains, dividends, interest, completely tax-free forever. RRSP, tax-deferred. All growth sheltered until withdrawal, then taxed at marginal rate. FHSA, tax-free for qualifying home withdrawal. Tax-deferred if transferred to RRSP. Winner for long-term growth. TFSA and FHSA for home purchase, tied at zero tax. Dimension 3, tax treatment on withdrawal. TFSA, zero tax, always, for any reason. RRSP, fully taxable as income in the year of withdrawal, withheld at source. FHSA, zero tax if used for qualifying first home, taxable if transferred to RRSP and withdrawn later. Winner for withdrawal flexibility. TFSA. Dimension 4, contribution limits 2026. TFSA, $7,000 per year. Cumulative, $109,000 for eligible since 2009. Not income-linked, RRSP, lesser of $32,490 or 18% of prior year earned income. Income-linked, higher earners get more room. FHSA, $8,000 per year. $40,000 lifetime. Carry forward unused room 1 year. Maximum $16,000 in any year. Income not linked. Winner for high-income earners. RRSP, higher contribution room. Winner for low to mid-income and flexibility. TFSA. Dimension 5. Flexibility and withdrawal rules. TFSA, maximum flexibility. Withdraw anytime for any reason. Room restored next year. No age limit. No forced conversion. RRSP, lower flexibility. Withdrawals fully taxable. Room not restored on withdrawal. Must convert to RRIF at 71. FHSA, moderate flexibility. Must be used for first home or transferred to RRSP. Account must be closed by December 31st of the year after the first qualifying withdrawal, or by December 31st of the 15th year after opening, or when turning 71, whichever comes first. Winner for flexibility. TFSA. No competition. The summary table. Action step. For each of the 5 dimensions, identify which one matters most for your specific situation right now. The dimension you rank highest points directly to the account that wins for you. Here is the most practical section of this video, because the right account depends critically on your current income and marginal rate. Below $30,000, TFSA first. At low incomes, the RRSP deduction generates a smaller immediate refund because your marginal rate is lower. At $30,000 Ontario income, the combined marginal rate is approximately 20.05%. A $5,000 RRSP contribution generates only approximately $1,003 in refunds. The TFSA's tax-free growth on the same $5,000, compounded over 30 years at 8%, produces $50,313 tax-free. At a low income in retirement, the RRSP withdrawal may be taxed at a similar or identical rate to today, eliminating the tax arbitrage benefit. TFSA wins clearly at low incomes. $30,000 to $50,000. TFSA first, FHSA if buying. Still in a relatively low marginal rate band. TFSA provides better flexibility and equivalent or better long-run outcome. If buying a home, FHSA is an immediate priority because the deduction at 20% to 26% still generates real refunds and the withdrawal is completely tax-free. Stack FHSA and TFSA simultaneously. $50,000 to $80,000. FHSA first, if buying, then TFSA, then RRSP. The marginal rate is climbing, 29% to 33% combined at this range in Ontario. RRSP deductions become meaningfully more valuable. But the FHSA, if buying a home, remains the top priority because it delivers a deduction and a tax-free withdrawal. After FHSA, TFSA for flexibility, then RRSP for additional deduction. Per the GrowSimple.ca analysis, if your marginal rate is below 30%, lean TFSA. If above 35%, lean RRSP. Between 30% and 35%. Lean TFSA for flexibility. $80,000 to $100,000. RRSP gains. Importance: at $100,000 Ontario, the combined marginal rate reaches 43.41%. An $18,000 RRSP contribution generates approximately $7,814 in refunds. That refund reinvested into the TFSA compounds tax-free for decades. The RRSP refund to TFSA loop becomes extremely powerful at this income level. Priority FHSA, if buying, to RRSP for refund loop to TFSA above $100,000. RRSP is critical. TFSA remains important. At top marginal rates, every dollar of RRSP contribution saves 43 to 54 cents in immediate tax depending on province. The arbitrage between contribution rate, 43% plus, and expected retirement withdrawal rate, likely 20% to 30% on median retirement income, is the most powerful legal tax reduction available. Maximize RRSP contribution first, then TFSA, FHSA if still eligible. The Questrade 2026 guidance for a 26-year-old earning $55,000. TFSA first, open FHSA for the down payment, and as income rises past $70,000, begin RRSP contributions. This sequencing reflects the income level priority exactly. Action step: find your Ontario combined marginal rate using the KPMG 2026 rate table. Free online. If below 30%, TFSA. If 30% to 35%, TFSA with RRSP consideration. If above 35%, RRSP is critical. Add FHSA immediately if you are a first-time buyer at any income level. Here are 4 real Canadian profiles, each one matched to the correct account priority using the 2026 rules. Profile 1, Maya, 26, earning $55,000, saving for a home and retirement. FHSA first. Open immediately. Contribute $8,000 per year. At $55,000 Ontario income. The FHSA deduction generates approximately $2,080 in tax refunds. Withdrawal for the home purchase is completely tax-free. Carry forward unused room for a maximum $16,000 contribution in year 2. Simultaneously, TFSA for any savings beyond the FHSA, RRSP. Wait until income rises above $70,000 before prioritizing. Per Questrade, 2026. TFSA first. Open FHSA for the down payment. As income rises past $70,000, start RRSP contributions. Profile 2. David, 38, earning $95,000, does not plan to buy a home. RRSP priority. At $95,000 Ontario income, the marginal rate is approximately 43.41% on dollars, above $100,000, and approximately 33% on income in the $70,000 to $100,000 range. A $15,000 RRSP contribution generates approximately $5,000 to $6,500 in immediate tax refunds. Reinvest every refund into the TFSA. TFSA is funded second, with whatever remains. No FHSA, not a first-time buyer. Profile 3. Jennifer, 62, earning $80,000, planning to retire at 65. TFSA priority, not RRSP, per GrowSimple.ca's 2026 analysis. Jennifer's case is a clear TFSA winner over RRSP. Contributing to the RRSP now creates more taxable RRIF income at 71 plus when she is forced to convert, potentially pushing her into a higher tax bracket than she is in today. TFSA contributions generate 0 future mandatory withdrawals, do not affect OAS clawback, and remain completely flexible. Jennifer should prioritize TFSA until retirement, then draw from RRSP/RRIF strategically to minimize OAS clawback. Profile 4. Amir and Sarah, dual income household, $70,000 and $120,000. Spousal RRSP for Amir. Sarah, the higher earner at $120,000, contributes to a spousal RRSP in Amir's name. Sarah claims the deduction at her 43% plus marginal rate. In retirement, Amir withdraws at his lower rate, splitting retirement income and reducing the family's total tax bill. Both max their individual TFSAs simultaneously. Sarah also contributes to her own RRSP up to the limit. Combined RRSP plus TFSA plus refund loop strategy produces substantially more lifetime wealth than either account alone. Action step. Which of the 4 profiles is closest to your situation right now? The account priority for your profile is your starting point for the next contribution decision. Here is the complete decision framework, delivered in the correct sequence for every Canadian situation. Step 1. Does your employer match RRSP contributions? If yes, contribute enough to capture the full employer match before anything else. This is a 100% instant return on that capital. No other financial decision produces a comparable outcome. Step 2. Are you a first-time homebuyer planning to purchase in the next 1 to 15 years? If yes, open an FHSA immediately and contribute up to $8,000 per year. The FHSA is a once-in-a-lifetime opportunity. Contribution room only accrues while the account is open, you can only use it once, and it delivers both an RRSP-style deduction and a TFSA-style tax-free withdrawal. Open it today, even if you cannot contribute the maximum immediately. Step 3. What is your current combined marginal tax rate? Below 30%. TFSA next. The RRSP deduction is too small to justify losing TFSA flexibility. 30% to 35%. TFSA for flexibility, unless the RRSP refund is specifically needed this tax year. Above 35%. RRSP next for the refund, which goes immediately into the TFSA. Above 43%. RRSP is critical. Maximum contribution. Every refund into TFSA. Step 4. Reinvest every RRSP refund into your TFSA immediately. The refund loop is the most commonly missed step. Most Canadians receive their RRSP tax refund and absorb it into spending. The correct move is to pre-authorize a lump sum TFSA contribution for the expected refund amount, so it flows directly from the refund into the TFSA without touching your spending account. Step 5. Review annually. Income and life stage change the answer. A 28-year-old at $55,000 should be FHSA first. The same person at 35 earning $95,000 with a home purchased should be RRSP first. At 62 with $80,000 income and similar expected retirement income, TFSA. The decision is not static. It evolves with your income and life stage. Review it every year at tax time. The one-line summary for each account. TFSA, the most flexible account. Use it for every financial goal. The default when uncertain. RRSP, the most powerful account for high-income earners. Use it for the deduction and the refund loop. FHSA, the best account ever created for first-time buyers. Use it the moment you qualify. Open it before you need it. Action step. Right now, answer the 5 questions in the decision framework. Write down the answer. That is your personal account priority for the next 12 months. Let's come back to where we started. You have $500 this month. TFSA, RRSP, and FHSA all available. Now you can answer the question. If you are a first-time buyer, the $500 goes to the FHSA, tax deduction today, tax-free withdrawal for the home, the best of both accounts. Do not delay opening it. Room only accumulates while it is open. If you are a high-income earner above 35% marginal rate without a home purchase planned, the $500 goes to the RRSP. The refund it generates goes into your TFSA. The refund loop runs every year. The gap between contributing at 43% and withdrawing at 23% is one of the most powerful legal tax strategies in Canada. If you are below 30% marginal rate, the $500 goes to the TFSA. The RRSP deduction is too small to justify losing flexibility. The TFSA gives you the best long-run outcome at lower incomes with zero restrictions. If your employer matches RRSP contributions, the first dollars go there before anything else. The match is a 100% instant return that no other account can replicate. The accounts themselves are not the point. The sequencing is the point. As Ferguson Financial Planning's March 2026 analysis concluded, the account order often matters more than the account limits. Limits changed a little for 2026, but your results can change a lot when you stop asking, "How do I max everything?" and start asking, "What does my next dollar need to do?" Answer that question. Every year, at every income level. That is the complete TFSA versus RRSP versus FHSA answer.